Hey everybody, it's Kevin from Kraken Futures. You'll often hear people talk about getting liquidated. In this video, we're going to discuss why liquidations exist in the first place, what it means when a position is liquidated, and how to avoid it happening to you. The story of liquidations actually starts with traditional finance. When you trade with leverage in traditional markets, you still have a lot of the same underlying concepts. And in traditional markets, it's still the platform's responsibility to make sure you have adequate margin to fund the trade. However, sometimes things go wrong. For example, let's say you're trading with 10x leverage, so a 10% price move will result in a 100% profit or loss. But what happens if you're in the traditional markets and there's a sudden 20% move? Well, if you're right about the trade, you've made a 200% profit. If you're wrong about the trade, you've made a 200% loss. And you have what's called negative equity. In traditional finance, you are still responsible for covering the full value of that loss. The brokerage platforms have the legal right to come after your assets in real life to cover the negative equity, and they do come after you. That's why when you're trading on traditional venues, you'll often see that when you trade with leverage, there's a disclaimer, quote, losses can exceed deposits. In crypto, we built the infrastructure from scratch, and in crypto, a trader can never go into negative equity. It's an important distinction and one worth highlighting, especially to people who have traded with leverage in traditional markets. At Kraken Futures, you can never lose more money than what you've placed into your futures wallet explicitly to be used as margin. There's no concept of negative equity on Kraken Futures. And that's in stark contrast to traditional markets. With us, your losses cannot exceed your deposits. Now there are three terms we need to introduce: initial margin, maintenance margin, and liquidation. Initial margin is the minimum amount of funds that you need in your futures wallet to enter a given trade. For smaller trade sizes, the initial margin is set at 2%. That's where the 50x leverage comes from. This means you only need to have 2% of the notional position size at the time you enter the trade. For example, if you want to go $50,000 short on Bitcoin, you would need to have 2% in initial margin. In other words, you need to have $1,000 in available margin to enter that position. As the trade sizes go up, the risk to the overall platform does increase, so the initial margin requirement increases as well. You can see the full initial margin schedule on the link below. Maintenance margin refers to the minimum amount of available margin required to keep the position open. Maintenance margin will always be lower than the initial margin. And when the maintenance margin number is hit, the position will be liquidated. For smaller trade sizes, maintenance margin is set at 1%. This means that as long as you have 1% of the notional position size in your futures wallet, you can keep the position open. Returning to our previous example of going $50,000 short in Bitcoin, you would need to maintain at least $500 in available margin to hold that position open. And please remember, you can always add money to your futures wallet even while the position's open. It's now worth pointing out two quick things. First, value calculations for initial and maintenance margin use the mark price. Second, initial margin and maintenance margin are always in the underlying asset. So if you're trading Bitcoin, your Bitcoin margin balance is the relevant amount. Now let's discuss liquidations. The liquidation process is how we ensure a client never has negative equity. The simplest way to describe a liquidation is that when the mark price hits your liquidation price, your position is liquidated. If your position is liquidated, your position is closed, and you should assume the margin balance in that token will go to zero. When a position is liquidated, the exchange assumes responsibility for the position, both the notional risk as well as the remaining margin amount. Each exchange has its own way of handling a liquidated position. At Kraken Futures, we utilize the position assignment system that's been running successfully since 2018. One way to avoid liquidations is to place a stop-loss order and have that order trigger before the liquidation price. We'll discuss how to do this in the advanced order type segment. In conclusion, unlike traditional markets, when you trade on Kraken Futures, your losses cannot exceed your deposits. Initial margin is the margin required to enter the position. The larger the position, the more initial margin required. Maintenance margin is the amount of margin required to keep the position open. When maintenance margin threshold is hit, the position will be liquidated. Mark price is the price to pay attention to for maintenance margin. If your position is liquidated, your position is closed, and you should assume that the margin balance in that token will go to zero. One way to avoid being liquidated is to place a stop loss order before your liquidation price, and we'll show you how to do that. Thank you very much. Please follow up with questions. Thank you. Bye-bye.